Hi, I'm happy to share with you an update of the September version of our monthly research publication Alpha Strategist. But before I dig into the market details, I am very pleased to share with you that we won the Best Boutique Wealth Manager Award by The Asset AAA. This is the second time in the row that we are winning this award. What makes this award more special to us is because a few of our clients were polled before the jury decided on giving us this award for India. Thank you very much for the clients who've agreed to be polled for this award, and this refreshes us, and also we strive to work harder and bring you the best advice at all points in time. As far as markets are concerned, globally, we continue to see trade tensions between China and US grow. As a result, what China has chosen to do is it has chosen to depreciate its currency, and this is having an impact across emerging market currencies. Rupee has been no exception. Whilst the trade wars are playing out, we are also seeing growth slowing down across major economies in the world, and this is leading to yields further going lower. Many countries' government securities bonds are now trading in the negative yield territory. The recent one to slip into negative territory is France. So about $17 trillion worth of bonds are trading in negative territory. So a massive amount of liquidity is available globally at very cheap or negative yields. As far as India is concerned, we are grappling with our own challenges locally. The latest GDP number was not very encouraging. Growth has slowed down to 5% for the last quarter. This does not augur too well from a growth perspective. However, investing cannot be directly correlated to the economy or near-term growth numbers. It's a complex process of trying to estimate many things. To put this in perspective, let me look at three main factors which drive returns in the longer term. In the longer term, the three main factors are: one is fundamentals. Now, if I look at fundamentals, the growth outlook is definitely weakened for many companies in India, and this quarter's earnings review was probably one of the worst after a long time. We saw low single-digit profit growth and low single-digit sales growth. This basically tells us that the demand outlook for many sectors has weakened, so has profitability. Negative operating leverage may have also played a role in bringing earnings down. Notable sectors which have been hit are consumption sectors, discretionary consumption, especially automobiles. Fundamentals in terms of balance sheets have gotten better over the last few years. A lot of the banks have already provisioned for their NPAs and are looking good. In fact, corporate banks are expected to add to profitability next year. Of the 18% profit growth that we expect, almost 13-14% is expected to come from corporate banks like ICICI, SBI and Axis. So we believe that even if demand outlook remains a little weak and growth is slow, profits can grow much faster than previous years. So that should keep markets buoyant. Second, if we look at some of the other fundamental indicators like valuations, we've seen large caps not correct much. We've seen the Nifty correct about 4-5%. However, a lot of companies, even within the Nifty, have corrected closer to 10, 15 or 20%. So there are about 10-12 companies which are holding the Nifty up, which constitute about the top 10 companies constitute 55% of the Nifty. So there's a huge polarization and dispersions in valuations at the moment. The mid and small cap indices have fallen quite sharply from their peaks. Mid cap has fallen close to 25%. The small cap index has fallen close to 35-40%. So if I take away the top 15-20 companies in terms of weightages or valuations, markets are available at pretty reasonable valuations. I mean, you're seeing after a long time that there are many companies which are available in the mid-teens or some even in single-digit P multiples. So depending on which portfolio you invest in, you can get pretty reasonable portfolios today. And normally reasonable valuations are a harbinger of decent returns in the future. So if I look at fundamentals, valuations are in your favor. However, like I said, the growth outlook has weakened. Balance sheet is stronger. I mean, as a country, we are much better off. Current account deficit is under control. Fiscal deficit numbers are pretty decent, and corporate balance sheets have been deleveraging over the last 4-5 years, so they are much better off today. And whatever leverage that we saw, which have piled up at the promoter level, is getting cleansed out as we speak. The third part which drives returns is essentially, the second part is sentiment. Sentiment, if I look around, is very, very weak and pretty negative. And the reason for that is this is the first time after many years, I'm seeing that a lot of asset classes are headwinded. So whether it is real estate, whether it is equities, to an extent even debt, especially in credit funds, we've seen certain mishaps. And gold also, barring the last 6 months, last 3 to 5 years, has not done that great. So for the first time, we are seeing many asset classes being headwinded in terms of returns, and we are also seeing business sentiment being negative. Normally, when sentiment is so negative, returns from equity markets are pretty positive over the next 2 to 3 years. These are contrarian indicators which essentially tell you that markets are close to bottoming out, and normally these indicators are far stronger than some of the numbers or valuation indicators. The third part is liquidity. If I look at liquidity, FIs have net sold about $4 billion in the last 2 months. For the year, they're still positive about $6 billion, but $4 billion of selling is quite a lot of selling in a span of 2 months. And normally when FIs sell a lot, those are contrarian indicators that from that point on you make decent returns. So we believe that if you look at fundamental sentiment and liquidity, all three at the margin are positive for investments in equity markets, and we believe that these are great times for people to accumulate equities, possibly now or over the next 2 to 3 months. Looking at your asset allocation, I would go to the extent of saying that there is an opportunity to go even overweight over the next few months if markets turn cheaper. As far as the debt markets are concerned, we believe that there is extreme risk aversion at the moment, and we continue to recommend high quality AAA accrual funds. Having said that, yields have come off quite a bit. Today, AAA yields are close to 7.25. So funds will yield you even lower than 7 over the next 3 years. And we strongly believe that credit funds are looking attractive. So one should not shy away from allocating some money in credit. A good way to do it is to probably do an SIP or an STP and get close to 20-30% credit in your portfolios. We have a set of recommended funds you could look at, because yields currently are closer to double digit in a lot of these funds, and typically these kind of yields and spreads are very, very attractive, and historically whenever somebody has invested in credit at these levels, they've done well. However, a word of caution that I think an SIP approach or STP approach is better than a lump sum approach at this stage, because you could see a few more negative credit events in the near future. We are positive on gold as an asset class. However, one should view it as an insurance in the portfolio in event that something goes wrong globally and global markets correct sharply, or there is currency volatility because of the trade war tensions that are going around. So having 5 to 10% gold exposure, depending on your risk appetite and your asset allocation, is not a bad idea as you go into markets over the next year, 24 months. So like I said, there is extreme caution right now across the board, but normally great opportunities are found at times of maximum pessimism and opportunity and caution. So I would say that these are times to be a little more aggressive in terms of allocation and look at some of the asset classes which have not done well over the last 18 months or 24 months. And these are asset classes which are probably causing you pain also at this point in time in the portfolio. But trust me, over a period of time, you will find that these are portfolios which will also give you the maximum returns over the next 3, 4, 5 years, as valuations have also moderated. With that, I close my update.